probably think this is inflation. The renewal notice came in the mail. The number was higher, much higher. And you did what almost every household in America did that week. You sighed, you said the word inflation, and you paid it. Here's the problem with that word. It doesn't survive the subtraction. Between 2020 and 2025, home insurance rates in the United States climbed 46.8%. That's LendingTree's State of Home Insurance Report for 2026. Over that same stretch, general prices rose about 25%. Those are two different measures, so hold them side by side rather than stacking them. But hold them there for a second because the gap doesn't close. The national average home premium sits at $2,395 a year. Work backwards through that 46.8%, and the same average policy was about $1,631 in 2020. Now let inflation, and only inflation, carry that number forward. 25% gets you to about $2,039. You're paying $2,395. So the increase was $763. Inflation accounts for roughly 408 of them, and $355 a year, nearly 47% of your increase, is something else entirely. Something with a different name. Something nobody put in the letter. That's the number this whole thing is about, not the total. The remainder, and that's the national average, which is a gentle way of putting it. Averages hide people. Every single state saw rates rise across those 5 years. All 50, no exceptions. But they did not rise evenly. The average annual premium in Oklahoma is $5,298. Nebraska, $4,956. Colorado, $4,310. Those are not outlier zip codes on a coastline. Those are entire states in the middle of the country paying more than double the national average from 5 years ago. So when someone says their bill doubled, they are usually not exaggerating, and they are usually not confused. They are simply standing in a state or holding a combination of policies where 2 or 3 of these forces landed at the same time. A recent CNBC survey found 42% of homeowners saying their insurance costs had gone up a lot. Not a little, a lot. That's not a fringe experience. That's 4 in 10 households. And once you see what's inside that remainder, you'll understand something much stranger. Which bill in your house is actually the expensive one? It isn't the one that doubled. Start with what a renewal notice really is. Your home policy is a 12-month contract. Your auto policy is usually 6. That's not a billing convenience. That's the entire architecture. Every time one of them expires, the company gets to do something it could not do for the previous 12 months. It gets to look at you again. New data, new models, new losses, new rules, and it gets to write a new price for the risk of being you. You didn't get a price increase. You got Re-Underwritten. Think about how odd that is compared to everything else in your budget. Your mortgage rate was locked the day you signed. Your car loan was locked. Even your phone contract has a term. But the 2 policies you're required to carry, the one your lender demands, the one your state demands, are the 2 that get repriced on a schedule forever with someone else holding the pen. Now, what did they see when they looked at you again? 3 things, and only one of them is what you'd call inflation. The first is rebuild cost. Here's where most homeowners get blindsided. Your insurer is not covering what your house is worth. It's covering what your house would cost to reconstruct from the foundation up using today's labor and today's materials. In a week when contractors in your county are booked solid, your home's market value can sit flat for 3 years while its replacement cost climbs the whole time. And you can go a decade without ever filing a claim and still pay more every single year because the company's exposure on your address went up even though nothing at your address changed. That one really is a cost story. Lumber, copper, aluminum, drywall, and a construction labor shortage that hasn't cleared. The second is frequency. Between 2020 and 2024, the United States averaged 23 separate weather disasters, causing at least $1 billion in damage. Every year. In the 5 years before that, the average was 15. That's not a worse storm. That's a different denominator. Insurance math is built on how often and how often changed. And the third is the one almost nobody names out loud. Swiss Re Institute tracks something it calls social inflation, the part of claim costs that comes from the legal system rather than from wages or prices. Their finding is blunt. Roughly 60% of the growth in U.S. liability claims is now non-economic. It isn't the cost of the repair going up, it's the cost of the verdict going up. Between 2017 and 2022, claims costs attributable to social inflation grew 5.4% a year against 3.7% for ordinary economic inflation. And Marathon Strategies counted nuclear verdicts, jury awards over $10 million, rising 52% in a single year, 2024, to a record 135. Sit with that. There is a second inflation running inside your premium. The Bureau of Labor Statistics does not measure it. It doesn't show up on the news as a percentage each month, and it is quietly repricing the liability half of every policy you own. Auto tells the same story even louder. The Consumer Price Index for motor vehicle insurance is roughly 50% above where it stood in 2020, double the general rate. It peaked at nearly 20% year over year in the summer of 2023, and it was still running above headline inflation in early 2026. Same three engines: repair costs, frequency, and verdicts. Before this goes further, one thing worth having in front of you. There's a free checklist of the clauses that decide whether your own policy can be repriced and where to find them in your paperwork. The link is in the pinned comment. So, rising costs, rising storms, rising verdicts, case closed. Your bill went up because risk got more expensive. Except that's where this falls apart. Because there's one place where the price of risk is measured openly, and it isn't your mailbox. Insurance companies buy insurance too. It's called reinsurance, and it's the wholesale market for catastrophe risk. When storms get more expensive, that market is the first place it shows. It's the closest thing there is to a live ticker on what danger costs. At the January 2026 renewals, that ticker went down. Guy Carpenter's U.S. Property Catastrophe Rate Online Index fell 12%. Howden Re measured risk-adjusted property catastrophe pricing down 14.7%, the sharpest single-year drop since 2014, with retrocession down another 16.5%. Programs across the U.S., Europe, and Asia-Pacific came down 10 to 20%. And at the June renewals a few months later, they came down again, 10 to 25% depending on the program. The wholesale price of catastrophe risk is falling, has been for 2 years. And the projection for your home premium in 2026? Up again, 5th consecutive year. Now hold both of those in your head at once, because this is the whole video. If your bill were tracking the cost of risk, your bill would be falling too. It isn't, which means the thing driving the number on your renewal notice was never simply the cost. Costs move in both directions. Your premium only learned one of them. What's actually moving is permission. Filings approved this year cover losses from 3 years ago. Models updated this year price a hurricane season that hasn't happened. Rate adequacy that carriers spent years asking regulators for is now landing in your mailbox. Long after the market that caused it already turned, you are paying on delay for a fire that's already out. Does that mean your insurer is scheming against you? No. State regulators hold the actual pen on rate filings, and that approval process moves slower than the market does. The lag is bureaucratic, not sinister. But the number on your renewal notice doesn't know the difference. It still isn't tracking the cost of risk. It's tracking permission. You can see the delay in the shape of the increases themselves. Watch the year-by-year numbers from that same lending tree series. 2020, rates up 2%. 2021, 2.8%. 2022, 5.2%. Then 2024 arrives, and the increase is 12.7%, then 6%. Now compare that to when the losses actually happen. Costs in catastrophes climbed steadily from 2020 onward. The premiums didn't. They crawled, then jumped, then eased. That is not the signature of a cost passing through to a consumer in real time. A cost that flows through immediately produces a smooth curve. What you're looking at is a pressure valve. Years of pent-up filings clearing at once, the moment approval came, which tells you something useful about the direction this runs. If the price you pay is set by permission rather than by present cost, then wholesale prices falling does not hand the money back to you. It just means the next round of filings has less to justify. The relief, if it arrives at all, arrives on the same delay the pain did, years late, and only in the states where somebody makes the case for it. And that reframes the entire question. Stop asking why insurance costs so much. Ask this instead. Of every policy your family pays for, which ones can the company reprice next year? And which ones can't? Because they are not all the same, and almost nobody sorts them this way. Your home policy, 12 months, repriceable. Your auto policy, 6 months, repriceable. Your health plan, annual, repriceable. Line them up and the pattern is uncomfortable. Nearly every insurance dollar leaving your account is on a contract where the other side sets next year's number. Except one. A level term life policy is the rare thing in a household budget with a price that is contractually locked, not usually stable, not historically flat, locked in writing for the level period. 20 years of storms, 20 years of verdicts, 20 years of reinsurance cycles, and the number does not move. If you bought $500,000 of 20-year coverage at 35, and the going rate today for a 35-year-old is $47 a month, you are still paying $47 a month. The company cannot look at you again. It gave up the pen. Now here's the part that stings. When the home bill and the car bill go up, and a family sits at the kitchen table deciding what to cut, the life insurance policy is very often the first line crossed off. It feels like the safe cut. Nothing breaks tomorrow. Nobody calls. The lender doesn't demand it, the state doesn't demand it, and the payment simply stops. So the household cancels the one contract with a locked price in order to keep paying the two contracts that get rewritten every year. Read that again slowly, because it's the exact opposite of what the math wants. And there are two more things nobody explains at that table. The first is that life insurance is not one category, and the lock is not universal. Universal life policies feel like they have a fixed premium. Many of them do not. Inside those policies sits a charge called the cost of insurance, and the contract typically reserves the company's right to raise it up to a guaranteed maximum. That right is not theoretical. Transamerica raised monthly charges on certain universal life policies by as much as 38%, affecting roughly 70,000 policyholders, and later resolved the resulting litigation with a $195 million settlement that included a multi-year freeze on further increases. Other major carriers ran their own cost of insurance increases in the same era, one of them near 100% on tens of thousands of policies. Run that on a policy with $200 a month of internal charges, and a doubling takes it to $400, $2,400 a year. And unlike your home policy, no renewal notice arrives to announce it. The money comes quietly out of the cash value until one day the statement doesn't look the way it used to. That's the second pen you didn't know was on the table. The second thing is bigger, and it's the one that closes this loop. The lock on a term policy has an expiration date printed on it. That's what 20-year term actually means. Not that coverage ends, often it doesn't, but that the guaranteed price ends. After the level period, most term policies convert to annually renewable coverage, and the price starts climbing every single year based on the age you are now. Here's the number. Using 2026 rate tables, $500,000 of 20-year term for a healthy 35-year-old man runs about $47 a month, $564 a year. The same $500,000 bought fresh at 55 runs about $231 a month, $2,772 a year, 4.9 times the price. For a woman, 4.5 times. Same coverage, same company, same person, 20 years later. Over 20 years, the policy started at 35 costs $11,280, started at 55, $55,440, a gap of $44,160 for the identical $500,000, and that assumes the best case, that at 55 you're still healthy enough to be offered a new policy at all. Health is the one variable in this entire video that no regulator, no reinsurer, and no filing can put back. A policy you drop at 42 because the car insurance went up is not a policy you can buy back at 55 on the same terms. You can always find more money. You cannot go back and be 42. So look at what actually happened in this story. Home and auto repriced every year on a delay for losses already absorbed in a wholesale market that has been getting cheaper for 2 years. Frustrating, expensive, and largely out of your hands. Life, the one price your family had actually locked. Cut first because it was the quietest line to cut. None of this means a specific policy is right for your household. That depends on your family, your dependents, and your budget. And it's a conversation worth having with someone who can see all of it. But the sorting question costs nothing to ask, and most families have never asked it. Pull the policies, not the premiums, the terms. For each one, find the answer to a single question. Can this company change my price next year without my signature? Home, yes. Auto, yes. Health, yes. Level term, no, until the date printed inside it. Universal life, check the cost of insurance provision, because the answer there surprises people. That's the whole audit. 10 minutes and a stack of paperwork. Because here's where this started. A renewal notice, a higher number, and the word inflation. Inflation explained about $408 of it. The rest was a company exercising a right you agreed to years ago and never read. And while you were staring at the bill that doubled, the quiet one at the bottom of the pile, the one with no increase, no notice, no drama, was the only price in the entire stack that nobody could touch. The bill that doubled was never the expensive one. The expensive one is the bill you canceled to pay it. That's not a loss you can't undo. It's a pen you can pick back up the next time a renewal notice makes you reach for the wrong bill to cut.